We are actually entering the phase of the late growth cycle.
Financial advisors, they are not that independent.
To form a passive long-term portfolio. And that's where bonds are playing a crucial role.
Investing in bonds, you are sure to get the fixed income. It may provide high returns. You're able to earn more.
Injection of bonds into the portfolio always gives you a better result.
Hi, I'm Untitled Chapter, and welcome to the first episode of the Human Finance Podcast, brought to you by Bondfish, the #1 platform for bond market data. Today, I'm joined by Bondfish co-founders Stanislav and Renat to tackle the most common questions we hear from users across Europe and the US. We'll cover what bonds actually do in a portfolio, where they fit in an investor's plan, and how to handle currency risk and hedging when choosing instruments. Hi guys, welcome to the first episode of the Bondfish podcast. In this show, we will regularly talk about the bond market, investment ideas, and questions from our platform users, platform called Bondfish. Our goal is to make the world of fixed income clearer and more accessible, more understandable, both for beginner investors and for experienced ones. Regularly, we will discuss key market developments, interesting trends, highlight opportunities worth watching. And I'm Anatoly from Bondfish. And today it's nice to have with us the co-founders of the platform. A big shout out to Stanislav and Renat. Hi, guys.
Hi, Anatoly.
Hi, Anatoly. Hi, everybody
Nice.
who watches this show.
Great. And today I will be your host on this journey through the world of bonds. We will talk about a few I would say the simplest topics, right? But the most interesting, in my opinion, the most important ones. Welcome aboard and let's get started. Okay, over the last 6 months, we've received many questions from users across Europe and the US, some using Bondfish as their primary source, primary bond tool, and most as a complementary one. Before recording this episode, I grouped the most common questions into a few themes so we can structure the discussion for both beginners and more experienced investors. So I will start with this one, which I found that the most relevant for the first question I will ask in our episode. In the world of many financial instruments and markets, why invest in bonds? Imagine someone just starting their career or in their 30s. What guidance would you give on asset allocation and how to choose between markets and in what proportions? Stas.
Sure. Thanks a lot, Anatoly. So yeah, this is indeed a very popular question that we face. And the answer is really simple because the asset class is very simple and it may provide high returns. So asset class, which is bonds, and bonds are also called fixed income instruments. So while investing in bonds, you are sure to get the fixed income. So you understand the return that you will have in the end. So I think everybody is familiar with savings accounts, bank deposits, term deposits, various ways of how we name it. And yeah, this is a very simple instrument, right? You just put money into a bank account and you'll have the return in the end. So with bonds, actually, this works the same. That's why I call bonds very simple asset class. But bonds provide higher return than what banks do. And this varies between various countries pretty much. For example, in the United States, the bank deposits the banks pay very low interest while compared to bonds. In Europe, the difference is of less less of a matter. So yes, it depends on the country. But what is true almost all of the time is that bonds pay higher returns, higher interest rates than what banks pay usually. That's why for those who want to get the fixed return, yeah, it's very simple just to put your money into bonds. There's another aspect of this. So you mentioned that there is a great variety of various assets available. And yes, indeed, bonds are really boring asset class because this acts almost the same as bank deposit savings account. But what bonds also do is that if they are inside your portfolio, they actually can decrease the volatility of your portfolio, right? Because equities do not grow all the time. Gold, well, like last 2 years, it really grows a lot, but there may be downsides. Don't forget about this. Real estate may also fall. And the more the asset classes that you have inside your portfolio, the more diversified you are, and the less and that makes your portfolio less volatile. So you won't feel pity when there is a market crash happens on one of these asset classes. And actually, with bonds, there is plenty of various researches that were done in the past that took a really, really long period of time and compared, for example, various portfolios where one portfolio had a substantial amount invested in bonds and the other amount in stocks, and another portfolio which was all in stocks, for example, in a volatile asset class. And what was surprising is that the bonds added, so the portfolio which had a substantial amount in bonds had much less volatility and much less of downsides. But speaking about the returns difference, so the returns difference was not big compared to the portfolio which consisted of stocks only. So just to sum up, my idea is that with bonds, you're able to earn more than on cash, right? On your like non-risky part of your portfolio. Then you may diversify your portfolio. And I also want to say that in many countries, you may not invest in some yield product easily that is denominated in foreign currency. For example, let's suppose I'm in Europe and I want to, I have a view that, say, dollars will, the exchange rate of dollar will appreciate in the future. So it's really hard to me to get a dollar deposit from the bank because banks usually do not provide dollar deposits here. But with bonds, you may actually invest in dollars, in pounds, in Japanese yen, etc. I mean, bonds provide you with the exposure to foreign currencies, and not only for interest-free, but also, yes, you may invest in bonds, which also provide the yield on that. So yeah, this is it.
Thank you very much for your answer, Stas. And Renat, what is your take on it?
Well, I think from my point of view, yes, Stanislav has pointed out main features of bonds. But I would like to stress the second feature is that bonds are a main diversificator for the stable portfolio. So I wouldn't call bonds an easy instrument. It's an easy idea. So bonds, fixed income instruments are called, they used to be called IOUs. So when someone borrows money from one party and that party gives you money back in some period with some percentage. So that's the main idea, and it's as easy as hell. So, and you understand, so mentally you understand the mathematics. When you come to the details, then that's where the devil delves into the details. So you just need to understand how the exactly mathematic works. So there are a lot of things that can can influence the good choice of a good instrument, and that's what actually we are doing. So, but like answering the question why bonds is because most, as I see it, so not many people are that financially savvy, and not everyone, well, maybe most of the people, they don't understand all the things that drive the markets. So what's the main take out of it is that the better option and the better choice for average man who wants to, or a woman who wants to actually financially protect and grow capital is to form a passive long-term portfolio. And that's where that's where bonds are playing a crucial role. And that's what Stanislav was talking about. In the long run, if we are talking about like passing couple of business cycles, the injection of bonds into the portfolio always gives you a better result. And yes, there are two aspects. It's the return, the total return in the end, and also the risk. And that's what Stanislav was talking about the volatility. So in the financial terms, risks is measured in volatility terms. Why? Well, it's not that direct. It's maybe a little bit counterintuitive, but it's very easy to lose capital when your portfolio drops, and you are actually very nervous about that. Many people, they just sell on the lowest point, and that's where the difference lies between professional people and non-professional people. So for non-professional people to be more, psychologically protected, that's actually the main feature of a good investment, is to be stable. To be stable mentally, you have to be protected, and your portfolio should be stable. So bonds, because they are lying on the other side of the cyclical field, as I say. So this is a business cycle. So economy expands, then it contracts, and different asset classes, they usually perform better in different stages of this cycle. So the magic here is to pick up maybe a little bit, so playing with the cycle, but maybe to pick up different asset classes in proper proportions, so that your portfolio is stably growing without paying too much attention on the stages of the cycle. So, and why bond now? I would say this is maybe another question, but to my opinion, we are actually entering the phase of the late growth cycle, and that's when the bonds really can show their better features. Yeah, well, it's hard to predict market cycles and market movements, but that's what all the individual investors, they should keep in mind. They just need to look at the history just to see that there are really cycles, growth and decreases, and just to think that this can actually, the history repeats itself. So, and to be on the safe side, you need to think sometimes conservatively. Yeah, that's why bonds.
That's interesting that you said, Renat, about the economic and business cycles, because the second question I had was about this. I recently read in a Wall Street Journal article, it was noted that around 10% of Americans invest in a substantial part of their income, their revenue, in 401k plans, are dissatisfied with the conservative options they are offered, because actually this money are mainly invested in ETFs, mainly, if it is America, it's invested in American stocks, and some part of them in bond funds as well. And these people, I mean, 10% of those that were surveyed, they said they would prefer crypto or alternative investments, mainly in crypto like field. And, it's kind of difficult to be cautious, maybe, after 15 years bull run in US equities, that was tremendous, that was of huge success. And now we have like a huge alarm of like debasement trade, like rising gold prices, rising crypto, at least like till like maybe last month or something like this. A strong gold rush, silver rush, I don't know. And actually, people are very complacent, you know? And is it like the right moment for the investors to become more cautious and maybe invest a bigger part of their portfolio in bonds? What do you think about it?
So yes, rise in equities, rise in crypto, rise in gold. Yes, this is cool. I have a lot inside my portfolio, so I am happy with this. But this growth won't be endless, right? Otherwise, everybody will be rich. So we will just invest all that we got. We just take the loan from the bank at a much lower rate and put it into equities or crypto. And yes, it's really easy to become very rich. But the problem is that these markets are volatile. This day will come when there will be some market crash or at least some correction. And just following what we've said already, me and Renat, is that bonds not to be that stressed once this event happens, and this event will happen. This is for sure. I mean, you just take the history of the various asset classes of the stock market, and you see that there is always correction. This is imminent, inevitable. In terms of what you said, that many Americans are dissatisfied with their options that they have. You mentioned conservative options, right? Or not only conservative?
I mean, they are considered like ETFs, global ETFs, and like American stocks ETFs and the bonds like conservative investments,
okay,
because they were allowed like in this package of fee for 401k like a long time ago.
Yeah, I think they just mainly invested in bonds. So I know those, they are 401k funds. They are maybe, I think they are the biggest in the world. Well, maybe I'm mistaken. There were some firefighters fund of some sort in USA, which is like major one. And I think they were really conservative over the past decade. But that's actually what I was talking about. So this is like it's been 15 years, and of course, equity and everything that grows with the economy just perform better. And that's where the hint is. So it's been growing for 15 years. There should be some thoughts everywhere in everyone's minds. When will the growth end? So it's just counter-natural to be growing all the time. As Stanislav said, it just if it were that easy, everyone would be rich and there would be like no inflation and everyone would be, going to Canary Islands and just spending the best of their lives. But the world is much more complicated. And well, the people who understand this, they always have like some second thoughts, they do research, they try to understand what are the rules and how the financial market works. So we are actually both with Stanislav, we are financial professionals. So we've had education, we've worked, we invested, we lost money, we earned money. So we have some experience, and everyone like partly or fully professional, they know that life is like a big cycle, and we can actually argue a lot when will this like growing cycle end, but it will actually end eventually. Yeah, well, the recession is actually usually the shortest phase of the business cycle. So it doesn't take a lot, but it doesn't take it shouldn't be taking a lot to wipe out all the wealth from the mostly risky investors. So on the other hand, it doesn't mean that you should be, timing the market and trying to short the risky assets because there will be some downturn in the nearest future. We actually can't predict it. this rally can actually take a year or two, or even maybe 5 years to go. So I'm not sure about 5 years, but yeah, well, I believe in 1 or 2 years that can easily actually be like that. But so how should you be? What should be your strategy if you want to, like, just to play safe on the one hand and not to lose money to the inflation? And that's actually the main question that we should be answering. Shorting the market can be really, really risky. I know a very famous story during the dot-com bubble. There was I don't remember the name of this investor. So he was, I think, the owner or the main trader of some really, really big fund. And just before the dot-com bust, he was actually giving the interviews. He was like very, very activistic about the idea that this is all bubble. It will all fall, and we should really, short the market. And he didn't say that. He actually was building he was shorting. So he was building a negative portfolio, shorting all those dot-coms. But he got bankrupt just before it all turned down. So he wiped, I think, hundreds of millions of wealth just being right, but not in the right moment. And
Market
that's also
timing
a
is
very
very
good,
important.
yeah, that's a very good story. So we are not, clairvoyant. We can't actually, no one can actually say that. No one can be that smart. But we can be really a little bit more, pragmatic. So if we can't time the market, but we understand that there is the risk that there won't be that many that much space left to earn with the growth of equities or alternative investments. So you should be maybe shifting more of your wealth to more conservative options, and that's where the bonds, well, and also the good choice of bonds play a crucial role, because maybe in other series we will be talking about what's the art of choosing the proper instrument. But just saying one thing, I would say that the quality really, really plays a lot of role. So just to get on the quality side and to get a good return, that's where actually the main key to success lies when we're talking about bond investments.
Yeah, nice. One thing to add here, and I think we forgot to do it, is and following what Renat just mentioned with this market timing thing. So what bonds actually do, they make you not care, about market timing. Because the best thing about bonds, yes, you may be absolutely incorrect in market timing. You may invest in bonds at low rates when the market rates go up, after some time. So, and which may make you feel pity about that. Okay, yeah, I should probably wait and invest at higher rates. But the wonderful thing about bonds is that you don't care about revaluation, about capital gains, because you know what you get in the end.
If you are
So
actually holding till maturity or till of
yes, if you hold till maturity, you know what you get. You know the fixed return that you will have. So that makes you feel okay not to predict the market timing for individual investor. You just know that you get the return.
Yeah, you can
Okay,
actually,
guys.
if you have, a positive capital revaluation, you can play a bit. But yeah, the other option, if you are actually having minus in your P&L, but you are a long-term investor, you can always hold this bond till maturity. Well, let's say it's a long-term bond and it's like 5-7 years, and you have like a negative P&L on that. But you are not in a rush. You can just leave it in 5-7 years, and if it's a good quality, what I was talking about, you will get your money back plus the coupon payments, and that's you will get the yield that you were actually projecting when you were buying this instrument.
You usually hold till maturity, right?
Not at
Not
all.
always. Yeah.
Not
Well,
always,
sometimes,
okay.
yeah, we have like, a man can have like some cash needs. But that's where
Right.
actually also bonds are a good instrument. Yes, you can be you can have a moment when you need cash, like a big cash spending, and the market is on the wrong side of your strategy, but
Very
still
true.
you have the option. Those instruments are marketable in contrary to the deposits, so you can pull the cash out, yes, with some usually not that critical losses, but that's
Maybe
also one
it's
of
not
the
loss. It may be
maybe
not a
it's not a
loss.
loss. Well, we are talking about maybe negative scenarios. Yes, it can be actually a plus. But liquidity is one of the also a
Yeah.
very key features of bonds in contrary to the to cash, and maybe also
Yeah.
to some equities. So you can have an equity portfolio. That was my experience. So I had a very good diversified cash portfolio, and I needed cash, and I just saw that one of the main stocks, well, it just took maybe about 15% of my portfolio. It was really drastically underperforming. That wouldn't be happening with bonds. So yeah, they can be like a negative PNL, but not that much. That stock was actually minus like 40%. And I was, what? I'm not, and that's when the main, so my idea was, well, if it's also already minus 40%, it can go even lower. With bonds of good quality, it doesn't happen. You just know that you should hold it till the end, and that's it. No worries, no nerves, no second thoughts. With equity, it's always like that. If it falls, you think, well, what can happen next?
Indeed.
Right.
And so you put all of your funds into this equity, right?
No,
Which gave you
no.
minus
I've
40%.
just I've done it like the Bond style. I just left it till the good times, and in 5 years it came back. But well, it was a risk, and there
Oh,
was a lot of nerves, and I was always, biting my nails to say, whether it was a bad decision and so on and so forth. Although I had a diversified portfolio, but I needed cash, so I wiped out all my portfolio except of this like negative position. That was also, from professional traders' point of view, that was a wrong decision.
Right.
But yeah, well, this happened. So I was lucky. Other times I could not be lucky. So I know the guy who actually was investing in structured fund, so a structured portfolio, some of
hmm
this sort. So he was like playing. There was like barrier options embedded into the portfolio. There were bonds and like 5 stocks. So and he would get the return on the lowest performing stock, for example. So and he just didn't get anything because one of the stocks, one of the like 10 stocks, it just bankrupted. And he lost all his capital. Although he should have he should have been gaining at least like 15% in
hmm
USD. But that was, one negative option. So if he got bankrupt inside of his portfolio, then he doesn't get anything. And that was actually the black swan in his case, and he lost, I think, about 50K. That was really painful.
Painful.
Painful. Yeah, good. Thank you very much, guys. Another question I have for you is that, okay, you were talking about professional investors and people who are um, deeply into it, right? And you yourself coming from the experience, your background in investment banking in the companies like Refinitiv, for example, in case of Renat. And but imagine a person without a major in finance but educated one and having a good salary, decent salary from European point of view, from perspective from different countries. It depends on what kind of decent salary you name it, the
hmm
country. But still, we know from the research we did for the users of our platform, we know that from the background, from the feedback that we receive from them, is that they are quite educated people and they have some some money, some cash to invest in. And is it possible for such a person, not majoring in finance, not having a background, not even 1/10 or even 1/100th of a background that you have, to do it yourself, to do it himself or herself, to invest every single year, to pick some bonds, and to, to be responsible for this kind of asset allocation, and just using your platform, bondfish.com, to make sure what kind of bonds from their perspective, from their strategy, is the best pick?
Absolutely. I think this is what we try to achieve here with our platform, to provide this kind of person to be able to pick the right bonds. I mean, those bonds which are appropriate, suitable for his case himself, without the need to call some financial advisor or call friends, etc., and to rely to some advice. So yes, because what is important for the person to take into mind when picking up the bonds suitable for him or her is first just to understand the term, the tenor that they want to lock their funds for. Second is to understand what's the return that they want to get. And third, what is the level of credit risk that corresponds to this level of return that they target. And this is exactly what we try to provide through our platform, to be able to search what kind of tenors of bonds are available, what kind of yields are available, and what level of credit risk corresponds to the yield levels of the specific issuers, of the specific bonds. With these tools in mind, actually, it is pretty much, this makes the case pretty much simple. Another question that users may have is how to determine what level of credit risk is appropriate, is suitable for them. In that case, well, that's why we try to make credit scale very simple. We provided 5 brackets from very low to very high. So I think it makes things easier to understand when we say that very low and low credit risk means that actually the probability of issuer going bankrupt is really low. So yeah, but if somebody wants to pick up the bond which is of higher credit risk because the bond provides a higher yield, there are several ways how to understand if the level of credit risk is appropriate. We provide the bond highlights. So with bond highlights on the Bondfish platform, we usually try to describe the business of the company or the government very easy manner, like very short one. What is this? What's the business? What they do? What's their finance? And say what are the advantages and risks, because you have to take into account. So we try to process the enormous amount of information to say to our users, to these do-it-yourself investors, what this means if they open position in this bond. What bet do they take on what kind of risk? Yeah. So another way is just to do it yourself, like to search the financials, documents, and news articles about the business of the company, and to try to understand if it is good enough or is it a reliable business or not. Obviously, this is a bit sophisticated, but nevertheless, those who have plenty of time and who are not afraid of doing this research themselves, actually, this is very interesting. I can say it maybe not for everybody, but for us coming from the financial sector, it's really interesting to delve into details. But yeah, it's affordable to pick up the right bonds yourself, to get a good grasp of business just from Googling the details of the company's businesses, etc.
Perfect. So no need to go to the financial advisor, and just with a very, understandable, not big amount
Yeah,
of, just
I'll
time
tell you.
between.
I'll tell you when you need to go to financial advisor. When you don't have time at all, just to even open the website and to search for bonds yourself or other kind of assets. If you also have someone who is professional enough to pick up the right instruments for you, for example, one of your best friends or one from your family, this is a good way just to to deal with this financial advisor from your
Some
inner
smart cat.
circle.
Yeah.
Smart cat, correct. But the problem with those, with absolutely independent financial advisors, is that they are not that independent. Because they actually, what they may do is that they may shorten the uh, list of instruments that they may offer to you, because they may have some kind of rebates, promotions, etc. from the banks,
Commissions,
other
yeah.
financial. Yes, that's why they are motivated to promote, to force you to invest in this or that bond, equity, commodity, structured product. By the way, very very popular these days. So yeah. But if it happens that you know someone and you trust this person, so yeah, and you do not have time and do not have interest in delving into the world of investments, so yeah, that's fantastic way. Just go ahead.
Yeah, it's always nice to have Stanislav as a good friend. He would always recommend some good bonds. Otherwise, you can actually just use our website. That's actually when Stanislav goes online. Yeah, and
So
uses and just
we also think that their financial advisors also visit Bondfish and just pick their bonds
yeah.
there. So that, no offense meant, but the
why
best
why use it
platform.
why use
Yeah, the
it?
best platform on the internet. So just if you didn't have an experience, didn't have chance to look at it, just please go to the just look at the link we have in the video description, and
Yes.
you will see it yourself. Okay, let's run the game. Okay, we have two case studies. Actually, we had like a few questions more coming from our users. I just picked two because they may be. I will just explain the reason why. The first one is from Italy. Italy is known as one of the most bond-loving countries in Europe, in European
Bond,
Union.
bond lagoons. Bond
Yeah,
lagoons.
lagoons, yeah, bond lagoons, and people just invest there in bonds, and they, it depends on whom you talk to in Italy, because there are some people who say, oh, our financial education is quite low here in the country, but still there are many people who prefer very diversified portfolios, who are pretty much risk averse, who think twice, even like 3, 4 times before buying some financial instrument. And this case is kind of, I just picked it up because it is from Italy. And professional, our user who wrote us is saying that, I think it's she actually, a 35-year-old professional with approximately 150K in total wealth. The current allocation is 50% bonds and 50% in stocks. And key priorities: euro-denominated returns and avoiding panic during equity drawdowns. What bond portfolio strategy would you suggest for this person?
The allocation is, from my point of view, is good. So I would stay in this allocation. Well, but there are actually other options how to diversify. So this is the asset class allocation, this is the geography allocation, and this is also the currency allocation. So this is actually usually goes along with the territory allocation. Yeah. So I know that the European investors and actually people in different European countries, they are a bit, conservative and more national directed. So they like actually national assets. And that's actually not unique this being a tendency all over the world. So the people tend. This is one of the psychological biases that is. So this is actually a separate subject now. The financial psychology. This is like the advanced level, and there are actually studies which show that this psychological bias is very um, stable. So people used to deal and invest and like go forward with something that they think they know. So they think that they know, like for example Italy, and they know everything about, they are writing like fiat, and they're using some products that they know. So they are usually more eager to invest in the brands and names that they know. And that's actually kind of a mistake from the savvy investor point of view. So you should be, I'm not telling you that you should be investing in everything that you don't know. That's actually not also a good case. But you should not be biased. You should not be, attached to something. And that's what I would be recommending to this investor. I would say that looking at some like USD bonds, or also maybe looking at some funds in some commodity funds a little bit, maybe some 10%, just to be also more diversified. That's what would be a really good idea in this case.
Okay, perfect.
Let me add to
Stas?
this. I'm against what I do not agree with what Renat said actually, because to me it sounds like, well, I think that the best way, so the best currency to prefer is actually not because of the bias that they have, that the investors may have, but because also this is really reasonable. You spend your money, you need to spend your wealth inside the country where you live, right? So this pretty much correlates to the currency of the country where you live. That makes really reasonable to invest and hold the majority, the largest part of portfolio in your domestic currency. This is not, I mean, you can diversify your portfolio with other currencies, but my point of view is that the majority, the major part of your portfolio should be in your domestic currency, because this is what you spend. You don't want to, with some situation when the dollar rate, well, I know exchange rate of dollar. So let's suppose it costs 0.5 against dollar, against euro, and yeah, you'll just have all of your, like, the half of your wealth just wiped out because it's in dollars. And in terms of bonds strategy, yes, I mean, what you said, Renat, is true. I mean, so that lady, right? So she had 50-50 for bonds and stocks. This is really nice. You always need to remember this is my way of doing investments, that you have to diversify all the time, not only for among asset classes or currencies, but also inside the asset class, for sure. For this particular case, yes, you may hold the little bit of everything, but the majority in this inside these two asset classes, this is okay. In terms of bonds, if the question is how to diversify the bonds portfolio, what the bond portfolio strategy the individual may choose and select. So I think that this also should correlate to the outflows in the future. For example, if this person has some discretionary items to be purchased in the near 3-5 years, maybe she has a house to invest in, like
Or
to
a
buy
mortgage,
a house.
yeah.
Yes, or to buy, or to get mortgage and to be able to fund the initial payment for this particular mortgage. So you should take this into account and to build your strategy according to the outflows that we have, because you don't want to put yourself into a situation when, say, you plan to buy a new house in 3 years' time, but you hold the all
10
of your
years.
bond portfolio in 30-year treasury bonds,
USD
or I know
treasuries, yeah.
30-year not USD. This is euro-denominated, but yeah, in bunds, in German bunds, because
Right.
who knows what will happen with the rates if they go up. So yes, the longer term bonds, they are very volatile. They may be very volatile. And in that case, in 3-year time, you will have the pretty much substantial negative revaluation
Growth, yeah.
and loss. That's why, yeah, you maybe you won't be able to afford yourself this house anymore. So
Absolutely.
yes, this should correlate a lot to the outflows and your plans.
Yeah, I think we will be talking later about this correspondence between yield and price of the bond and the term of
Hmm.
the bond. So it just, as
Hmm.
Stanislav said, the longer the bond, the more sensitive it is to the
Correct.
change of the yield
Interest rate.
of the interest rate. But yeah, I'm absolutely with you in this outtake. Yeah, well, that's actually also, we were talking about that earlier. So with bonds, you can choose the maturity of maybe of a part of your portfolio, and not to be dependent on where the interest rates go, how the markets conditions change, how the price of your portfolio change. You just can time up your part of your portfolio. Say 30% of your portfolio you can invest in some like 3 year bonds, also diversified, like 3-5 names, doesn't matter. And in 3 years you will have your like a 99% of probability that you will have like more of a probability, 99.999, if it's a good name, good credit quality, you will have your lump sum ready to be used. And that's actually one of the main points that all the retail investors should be taken into consideration. Planning. So investments is all about planning. That's where our portal comes in handy. You can actually, you have all the information at your hands, and you can like sit easily, just have your plan, see which instruments actually fit your profile, and make an easy choice. That's actually what we are here for. That's what was our main idea. So maybe we should just talk a little bit of why we just started this project. That was a handy problem. We just needed to also to invest our money. We didn't have like proper instruments at hand just to do this simple task, just to pick up the good names easily and just invest it and go forward with our lives. And we say, well, if we have this problem, maybe all other just people also should be having this problem. That's what we are actually trying to solve.
Okay,
Cool.
guys, and still we don't have much time. We still have the second case I picked from the UK. Why UK? Because a substantial part of our users and people coming to register to our platform, they are from the UK, and still London is financial capital. So I think there are many people in that country that analyze and maybe love this idea of, and have this idea of asset allocation and invest in bonds. The person who wrote us is a 47-year-old man, currently 20% in bonds, aiming to reach at least 40% over the next 10 years while preparing for retirement. Dislikes of bond ETFs due to past experience with low, unpredictable returns. Quite understandable. Currently holds gilts and a few UK corporates. So mainly invested, main currencies are British pound and American dollar. Now considering more stable options such as Swiss franc, but Swiss bonds are hard to source and yields are very low. What would you advise here?
So I think that I would advise the same that I already mentioned. I think that the largest part of portfolio should be invested into domestic currency. So which is pounds, right? I like the idea that the person wants to grow the share of the portfolio invested into bonds, because this makes perfect sense for everybody. Once you're young, you're able to invest into risky and volatile instruments, asset classes like equities or stocks, or equities, or I don't know, like commodities, crypto, yes, crypto, alternative investments, funds, etc. Because even if the market crashes and you lose the substantial part of your portfolio, you will be able to earn money because you're still well into power. Yeah, you're able to earn it from your projects or from your employment, etc. But once you mature, yeah, you don't have much time, and that's why you shouldn't risk. Yeah, much time left, unfortunately, and you shouldn't risk a lot. That's why the share of the less risky instruments should grow. Yeah, in terms of currencies, like CHF. Yes, Swiss francs that were mentioned. Well, I think that speculation on the foreign exchange movements is really hard. I mean, it's impossible to predict the currency if you are not George Soros, whom probably had some insights. I don't know, coming from the from the top levels, from the top government levels. But speculation on foreign currency is really almost impossible. That's why the best advice here is just to diversify again. Diversify, diversify, diversify. You have your portfolio in pounds mostly. Okay, you may allow yourself to have some part of a portfolio invested in various currencies, not only like dollars, but also to, yeah, like more yieldy or currencies. You may even invest in, I don't know, Polish zloty, etc., because the interest rates are higher there. Swiss francs were mentioned. There is indeed not that many Swiss franc bonds available right now, and the yields are very low. Why don't take into account euro as well? So the yields there are a bit less than what we may achieve on dollars or pounds, but nevertheless they are higher than with Swiss francs, and actually there is plenty of bonds available to invest. So yeah, euro is something to take into account as well. Yeah.
And Renat, your take?
Yeah, well, my take, yeah, talking about the currency diversification, I can't say that I'm fully agree. I fully agree with Stanislav here. So yeah, well, the main, I mean, the ABC knowledge, the foundational knowledge of investment management is that, yeah, you should be matching your inflows and outflows. So if you're actually living in a pound zone, yeah, well, main of your inflows should be planned to be in pounds. But I really like currency diversification, especially in the current world order, because they are quite volatile, and this volatility brings you an extra level of diversification if we take it statistically. I wouldn't say that you should, diversify and invest half of your portfolio in a different currency. But again, simple, 5% of your portfolio invested in other currency, I mean, even Asian currency, gives you a substantial level of, counter movements inside the asset prices. So yeah, I don't really like the CHF now, but this is actually the directional position. So if we're talking about the portfolio wise, yeah, I would just say that diversify a bit more, like a bit into euro, and maybe look at the Asian currencies. There are actually, if your broker actually allows you to be more diversified, so just use it.
Just use it and stay with it. Yeah. Thank you very much,
Yeah,
guys. It was a pleasure to talk to you.
Absolutely.
I really enjoyed
Likewise.
the conversation. I really enjoyed the conversation because I didn't expect to be that, that profound, I would say, and very informative. It's quite too much for the first podcast, for the first episode. Well, I would like to thank you, and just to say that the people who will watch this episode, and I hope they enjoyed it too. And thank you very much for watching. And you can just find in the video description below this video the link to our bond platform, Bondfish. Please explore it, sign up, and just share any feedback that you have using this platform. And also we will be joined. There will be another episodes with bond market experts, investors, and we will keep you posted on it. And also, a very particular point I would like to mention that we usually publish on a weekly basis the research made by Bondfish team, also present in this call by Stanislav and Renat and some other members of our Bondfish team. And it's very refreshing, it's very informative, and in very particular week you have insights in particular markets, countries, currencies, different types of bonds, top bond picks, bond investment ideas. So it's actually, once you're in the platform, it's free. Please explore it, research it, and use in your investment strategy, and be that person who, even maybe without financial specific education, is possible to build his or her bond portfolio themselves. Okay, thank you very much for joining us. Thank you very much, guys. Have a great one. Have a great evening. It was a pleasure.